Imagine a hidden drain in your investment account, subtly siphoning off your hard-earned money year after year. Most investors don't even know it exists, but banks certainly do. Today, I'm pulling back the curtain on the shocking truth about MER fees, the management expense ratio, and exactly why Canadian banks prefer to keep you in the dark. Stick around, because by the end of this video, you'll know how to spot this financial phantom and reclaim your wealth. Do you ever feel like you're doing everything right? Diligently saving, consistently investing for your future, yet your returns just aren't hitting the mark. Many Canadians share that exact frustration. You might blame the market, the economy, or even yourself. But the real culprit is often lurking, hidden in plain sight, deep within your investment statements. Exorbitant MER fees. These aren't just small charges. They're a significant chunk of your investment that vanishes annually before you even see any profit. It's a subtle, almost invisible tax on your ambition, silently eroding your nest egg. The shocking reality is, most investors are completely unaware they're paying these fees, let alone the true cost over time. This isn't just about a few dollars, it's about potentially crushing your retirement dreams. Please remember, this content is for informational purposes only and is not financial advice. Always consult with a qualified financial professional before making investment decisions. But there's a way out, and it's simpler than you think. Keep watching, because the next step is crucial to understanding the full picture. Here's the good news. You hold the power to change this. Today, we're about to demystify MER fees, exposing how they aggressively devour your wealth with real, relatable examples. We'll unmask the bank's secret agenda, revealing why they profit so heavily from these fees. Most importantly, I'll equip you with a straightforward, actionable plan to drastically cut these hidden costs, dramatically boost your investment returns, and finally, help you seize full control of your financial destiny. Get ready to transform your financial future starting now. Let's pull back the curtain on the invisible thief, the management expense ratio, or MER. What exactly is it? Think of it like a persistent, tiny leak in your financial pipeline. It's an annual percentage of your total investment that the bank or fund manager quietly extracts to cover their operating costs, things like portfolio management, administration, and even their marketing efforts. It sounds small, perhaps 1.5% or 2%, but it's a relentless, continuous drain that directly reduces your investment gains. Here's the uncomfortable truth. Banks have a deep-seated reason for not wanting you to scrutinize high MERs. These fees represent their most consistent, guaranteed stream of revenue, regardless of how well or how poorly your investments actually perform. Imagine running a business where you get paid a significant percentage of your customers' assets, whether or not those assets grow. That's the power of high MERs for them. And let's debunk a pervasive myth right here: the idea that higher fees equate to superior returns. Time and again, countless studies, particularly across the Canadian investment landscape, show this to be largely false. In fact, more often than not, funds with higher MERs tend to underperform their lower-cost counterparts over the long term after those hefty fees are subtracted. It's counterintuitive, right? But the data is clear. To illustrate, consider two hypothetical Canadian equity funds. Fund A has a MER of 2%. Fund B, a similar index tracking fund, has a MER of 0.25%. On a modest $10,000 investment, Fund A costs you $200 per year, while Fund B costs you just $25. In the short term, that $175 difference might not seem like a life-altering sum. But this isn't a short-term game. This is about decades of compounding, where small differences snowball into colossal impacts. This leads directly to your first action. Grab your latest investment statements. Look for MER, or Management Expense Ratio. If you can't find it, call your financial advisor or bank and demand to know. Understanding what these fees are and why banks aren't eager to highlight them is your critical first step in protecting your money. But seeing how these small fees transform into jaw-dropping losses over time, that's where the real awakening begins. You won't believe the numbers in our next step. Now, let's talk about the MER trap. How these seemingly small percentages silently crush your retirement dreams. We've established that MERs are annual deductions. But here's the kicker. The magic of compound interest, which ideally works in your favor to grow your wealth, also works relentlessly against you when it comes to fees. Every dollar taken by a MER is a dollar that cannot compound year after year, decade after decade. The cumulative effect of a high MER over the long haul is nothing short of financially devastating. It's not just the direct money subtracted, it's the lost growth on that money, the returns that money would have generated had it stayed invested. Let's put this into perspective with a realistic scenario for a Canadian investor. Imagine someone, let's call her Sarah, who diligently saves $500 every single month for 30 years. For simplicity, let's assume an average market return of 7% per year before fees. Now, let's compare two investment choices, one with a low MER, say 0.25%, typical of a broad market index exchange-traded fund, and another with a higher MER, perhaps 2.25%, common among actively managed mutual funds in Canada. With the low 0.25% MER, after 30 years, Sarah could realistically accumulate approximately $600,000 for her retirement. Now, brace yourself. If Sarah chose the fund with the 2.25% MER, despite the identical savings and market return, her accumulated wealth would plummet to around $380,000. That's a staggering difference of $220,000. Let that sink in. Over $220,000 vanished simply due to a seemingly small difference in annual fees. This isn't theoretical. This is how MERs ruthlessly steal a huge chunk of your future. It's the silent killer of retirement ambitions for countless Canadians. Your immediate action here is critical. Pull up an online compound interest calculator. Input your current investment amount, your monthly contributions, and a reasonable return percentage. Then, simulate the outcome with a 2% MER and then again with a 0.5% MER over 20 or 30 years. Seeing these numbers visually will be a powerful motivator to act. But how do you even begin to find these low-cost options and identify the high-fee traps in your current portfolio? That's exactly what we'll uncover next. Are you unknowingly overpaying for your investments? The unfortunate truth is many Canadian investors are. But here's the empowering part. It's surprisingly simple to spot those high MER funds lurking in your portfolio. Generally speaking, actively managed mutual funds, which are often promoted heavily by traditional banks, carry significantly higher MERs. We're talking percentages that can easily exceed 1.5% or even 2.5%. On the flip side, index funds, particularly exchange-traded funds or ETFs, and the portfolios offered by popular Robo-Advisors typically boast far lower MERs, often well below 0.5%, sometimes even under 0.1%. So why don't traditional banks shout about these lower-cost alternatives from the rooftops? It's simple: less profit for them. Their business model thrives on the recurring high-margin revenue generated by those hefty MERs. Promoting low-cost options directly undermines their most lucrative income streams. This is why you must be your own advocate. To identify the MER of any fund you own, look no further than its fund fact sheet or prospectus. These documents are legally required to disclose the MER. You can usually find them on your bank's website or the fund company's site. Take a Canadian equity mutual fund with, say, a 2.1% MER. Compare that to a broadly diversified Canadian equity index ETF, which might have an MER of just 0.06%. The difference in annual cost is astronomical. So what are these low-cost alternatives for Canadian investors? Instead of high MER mutual funds, consider exploring offerings from major low-cost ETF providers available on Canadian exchanges. These offer diversified portfolios that track major indexes, providing broad market exposure without the active management fees. Alternatively, look into well-known robo-advisory services. These digital platforms build and manage diversified portfolios for you using low-cost ETFs, often with an all-in fee well under 0.5%, encompassing both the ETF MERs and the robo-advisors management fee. Your immediate call to action: scrutinize every single fund in your portfolio. Find its MER. Then research low-cost ETFs or robo-advisor portfolios that mirror your current investment strategy. You might be shocked at how much you're losing. But once you have this knowledge, what do you actually do? Our next step is your complete action blueprint. Now that you understand the problem and recognize the powerful alternatives, it's time for your concrete action plan. This isn't about quick fixes. It's about smart, sustainable changes that will significantly boost your long-term returns. Here are 5 essential steps to slash your MER fees and pave your path to true financial freedom in Canada. First, audit your portfolio. This is non-negotiable. Go through every investment account, every fund. Pinpoint the MER for each. If it's unclear, demand clarity from your financial institution. You can't fix what you don't measure. Second, educate yourself. Understand the fundamental difference between actively managed funds and passively managed index ETFs. Actively managed funds often fail to beat the market after their high fees. Passively managed funds simply aim to match the market at a fraction of the cost. The data overwhelmingly favors passive investing for most long-term investors. Third, explore low-cost alternatives. Actively seek out low-cost ETFs that replicate the indices your current high-fee funds are tracking. If you own a high MER Canadian equity mutual fund, look for a Canadian equity index ETF. Or, for a hands-off approach, investigate reputable robo-advisor platforms offering diversified, low-cost portfolios managed automatically. Don't let loyalty to a specific bank cost you hundreds of thousands. Fourth, consider consolidating your investments. If you have multiple accounts scattered across different institutions, especially those with high MERs, think about consolidating them into 1 or 2 low-cost accounts. This simplifies management and often allows for greater efficiency in fee reduction. Remember, complexity often hides costs. Finally, act and monitor regularly. Don't just plan, execute. Initiate the transfer of your funds to lower-cost options. This might involve opening a new account with an online brokerage for ETFs or signing up with a robo-advisor. After making the switch, make it a habit to review your portfolio annually. Ensure your strategy aligns with your goals and that you're continually optimizing for lower fees. Choosing the first step and implementing it today is the most powerful move you can make. Every day you delay is another day your money is working for the bank, not for you. By following this clear, practical plan, you're not just saving money, you're actively building a stronger, more prosperous financial future. What you're about to gain is not just financial, it's true peace of mind. Let's talk about that. Every day you hesitate to address those MER fees is another day your hard-earned money is silently eroded. The journey to financial freedom isn't about uncovering secret formulas or overnight riches. It's built on a foundation of intelligent, consistent financial decisions. It's not about how much risk you take, but how incredibly efficient you are with the resources you already possess. Taking control of your investments, especially by tackling those hidden MER fees head-on, is undeniably one of the most impactful steps you can take for your long-term prosperity. Imagine the peace of mind knowing every dollar you invest is working its hardest for you, not for someone else's bottom line. This isn't just theory, it's a tangible change you can initiate today. Now, if this information resonated with you, if this deep dive into MER fees has truly opened your eyes to this often ignored aspect of your finances, please do me a favor. Hit that like button to spread this vital information. Subscribe to the channel for more unvarnished financial truths that empower Canadian investors just like you. And in the comments below, share your story. What's the highest MER you've discovered in your portfolio? Or which low-cost alternative are you most eager to explore first? Your insights help us all. Remember, financial freedom isn't some distant, unattainable mirage. It's a tangible reality built through the consistent, intelligent choices you make starting today. By taking the time to understand and decisively act on your management expense ratios, you are taking a monumental step towards a much more prosperous and secure future. Imagine looking at your investment statements years from now, knowing that every dollar of growth is truly yours, not being silently drained away by excessive fees. Envision a retirement where your hard-earned savings have compounded exponentially, unrestricted by unnecessary costs, allowing you to live the life you've always dreamed of. Your money should be a loyal servant, relentlessly working to build your wealth, not enriching someone else at your expense. You now possess the critical knowledge and a clear, actionable plan. The power is in your hands. Don't just watch this video and forget about it. Go forth, take control of your investments, and build the abundant financial future you deserve. Thank you for watching, and I'll see you in the next one, where we continue to demystify the world of Canadian personal finance.